Question 1. Scenario. Mr. Harris owns a large manufacturing business that faces significant environmental risk. He is considering establishing a captive insurance company to cover some of these environmental liabilities. He has already spoken to his financial advisor and an actuary about the feasibility of setting up the captive. Which of the following steps should Mr. Harris take next to proceed with the formation of his captive insurance company in Alabama? A. Register his business as a self-insurance company with the Alabama Department of Insurance, as captives are considered self-insurance entities. B. Submit an application for a license to the Alabama Department of Insurance, including his business plan, financial projections, and evidence of sufficient capitalization. C. Contact the IRS to discuss federal tax implications before proceeding with the licensing process, as tax treatment is more important than state compliance. D. Set up a fronting agreement with a commercial insurance company before applying for captive insurance registration to ensure his liabilities are covered. Answer. B. Submit an application for a license to the Alabama Department of Insurance, including his business plan, financial projections, and evidence of sufficient capitalization. Explanation. Mr. Harris must first apply for a captive insurance license with the Alabama Department of Insurance, ADOI. This includes submitting a comprehensive business plan, financial projections, and evidence of sufficient capitalization. According to Alabama's regulatory framework for captive insurance, the ADR requires this documentation to ensure the captive will operate within legal and financial standards. Option is incorrect because self-insurance is distinct from captive insurance, and captives require a formal licensing process under Alabama law. Option C is not the next step, as IRS tax treatment issues should be addressed after the captive is formed. Option D, although fronting agreements are common in some captives, is not a prerequisite for forming a captive in Alabama. Question 2. Which of the following statements best describes the role of the protected cell in a protected cell captive PCC insurance company under Alabama law? A. The protected cells within a PCC are subject to the same capital and surplus requirements as the core company, which allows for flexible risk sharing across different business units. B. Each protected cell operates as a separate legal entity with its own risk, which limits the financial liability of the core company and protects it from individual cell insolvency. C. Protected cells are primarily used for tax purposes, as their profits are not subject to federal taxation under Alabama's tax laws. D. The core company is responsible for the liabilities of each protected cell but can allocate profits from each cell to offset its own financial obligations. Answer. B. Each protected cell operates as a separate legal entity with its own risk, which limits the financial liability of the core company and protects it from individual cell insolvency. Explanation. Under Alabama law, a protected cell captive PCC is designed so that each cell operates independently with its own risks and assets. This structure limits the exposure of the core company to the liabilities of individual cells. In the event of insolvency in a particular protected cell, the core company is not liable for the debts of that cell, which helps to isolate risks. Option A is incorrect because protected cells are subject to different, less stringent requirements than the core company, making them more flexible in terms of risk-taking. Option C is incorrect, as the primary purpose of protected cells is not tax avoidance but risk segregation and management. Option D is misleading because while profits may be allocated within the PCC, the core company is not typically responsible for liabilities of individual cells. Question 3. What is the primary advantage of utilizing a group captive insurance company, particularly for small to medium-sized businesses in Alabama? A. The ability to access insurance coverage at a significantly low cost than through traditional commercial insurance providers due to shared risk across multiple businesses. B. The group captive can provide each member with tailor-made policies that address specific business risks, even if those risks are uncommon or specialized. C. Group captives allow businesses to transfer 100% of their risks to the insurer, relieving them from any financial responsibility for claims. D. A group captive allows a business to receive direct financial support from the state of Alabama for its claims management, reducing administrative costs. Answer A. The ability to access insurance coverage at a significantly low cost than through traditional commercial insurance providers due to shared risk across multiple businesses. Explanation. Group captives are particularly beneficial for small and medium-sized businesses because they allow participants to pool their risks, which can lead to reduced insurance costs. By sharing risks across multiple businesses, each member may benefit from economies of scale that would not be possible when purchasing insurance individually. Group captives can also provide coverage that is not easily available in the traditional market, but cost reduction is typically the primary advantage. Option B is incorrect because while group captives do allow for some degree of customization, the primary purpose of the group captive is not to offer highly specialized policies. Option C is incorrect because group captives do not transfer 100% of the risks. If businesses still retain a portion of the risk, which is part of the cost-saving structure. Option D is also incorrect as Alabama does not provide direct financial support for claims management in group captives. This is handled internally by the businesses within the group. Question 4. Which of the following best describes the relationship between a fronting company and a captive insurance company in Alabama? A. The fronting company acts as a reinsurance provider for the captive, taking on the majority of the risk while the captive handles the claims. B. The fronting company issues the insurance policies on behalf of the captive but retains a portion of the risk while the captive handles claims and premiums. C. The fronting company serves solely as a broker for the captive, managing claims but not participating in underwriting or risk retention. D. The fronting company is not necessary for a captive insurance company as captives can operate independently of traditional insurance markets. Answer. B. The fronting company issues the insurance policies on behalf of the captive but retains a portion of the risk while the captive handles claims and premiums. Explanation. In a captive insurance structure, a fronting company is typically a licensed insurance carrier that issues policies on behalf of the captive insurance company. The fronting company assumes a portion of the risk and may also retain some of the premiums. This arrangement allows the captive to offer policies to third parties while leveraging the fronting company's licensing and regulatory status. The captive itself manages the claims and premiums within its own structure. Option A is incorrect because the fronting company does not typically take on the majority of the risk. Option C is wrong because fronting companies are more involved than just serving as brokers. They issue policies and retain some of the risk. Option D is incorrect because fronting arrangements are often necessary for captives, particularly when dealing with external parties. Question 5. In the context of Alabama captive insurance, which of the following statements accurately describes the tax implications of a captive insurance company? A. Captive insurance premiums are fully deductible as business expenses under federal tax law, but captives must pay taxes on their profits at the state level in Alabama. B. Premiums paid to a captive are not deductible for tax purposes in Alabama unless the captive is a member of a group captive arrangement. C. A captive insurance company can qualify for favorable tax treatment by meeting the ERS's risk distribution test, which involves sharing risks with other companies or entities. D. Captive insurance companies are subject to both state and federal taxation at the same rate, as they are considered regular insurance companies under the law. Answer. C. A captive insurance company can qualify for favorable tax treatment by meeting the ERS's risk distribution test, which involves sharing risks with other companies or entities. Explanation. For a captive to qualify for favorable tax treatment, it must meet the ERS's risk distribution test. This test ensures that the captive is genuinely insuring risks and not merely a mechanism for tax avoidance. The IRS requires that the risks be distributed across multiple entities, typically by pooling risks with other captives or businesses. If the test is met, the premiums paid to the captive are deductible as business expenses. Option A is partially true regarding the deductibility of premiums, but it overlooks the need to meet the ERS's risk distribution requirement for favorable tax treatment. Option B is incorrect because premiums paid to a captive are generally deductible, not just in group captives. Option D is false because captives are subject to different tax treatments and the taxation is not the same as for regular insurance companies. Question 6. What is the primary purpose of a feasibility study when establishing a captive insurance company in Alabama? A. To determine whether the business model for the captive is sound and to estimate potential profits and losses under various risk scenarios. B. To ensure that the captive will be able to provide sufficient claims payments and meet capital requirements, but not to assess the overall business risks. C. To obtain approval from the Alabama Department of Insurance for the formation of the captive, including all operational details. D. To analyze the state of the insurance market and forecast future insurance premiums for the captive's members. Answer A. To determine whether the business model for the captive is sound and to estimate potential profits and losses under various risk scenarios. Explanation. A feasibility study is an essential part of the captive formation process used to assess whether the proposed captive will be financially viable. It involves evaluating the business model, estimating the potential costs and benefits, and conducting stress tests to understand how the captive will perform under different risk scenarios. The study ensures that the captive can meet the required capital levels and adequately address the risk it is insuring. Option B is incorrect because the feasibility study looks at a broader range of issues, including financial projections, operational viability, and overall business risk. Option C is not the primary purpose of the feasibility study, as it's more about assessing financial viability than obtaining approval. Option D focuses only on insurance premiums, which is a part of the analysis but not the primary purpose of the study. Question 7. Under Alabama law, what is the minimum capital requirement for the formation of a captive insurance company? A. $250,000, which is required to be maintained at all times in the form of liquid assets. B. $1 million, with at least 50% of the capital to be in cash or equivalent assets. C. The minimum capital requirement varies depending on the type of captive, but it generally ranges from $100,000 to $500,000. D. There is no minimum capital requirement for a captive in Alabama, as the state only requires captives to meet solvency and surplus requirements. Answer: C. The minimum capital requirement varies depending on the type of captive, but it generally ranges from $100,000 to $500,000. Explanation: in Alabama, the minimum capital requirements for a captive insurance company depend on the type of captive being formed. For a pure captive, the capital requirement is generally between $100,000 and $500,000, but the exact amount can vary based on the size and complexity of the business. The Alabama Department of Insurance (DOI) requires sufficient capital to ensure that the captive can meet its liabilities and operate soundly. Option is incorrect because the $250,000 requirement is not standard for all captives in Alabama. Option B is inaccurate because the minimum capital is not uniformly set at $1 million, nor is 50% required to be in liquid assets. Option D is incorrect because while captives may not have a single minimum capital requirement, they do have to meet certain solvency and surplus standards. Question 8. Which of the following best describes the role of an actuarial analysis in the premium setting process for captive insurance companies in Alabama? A. Actuarial analysis is used to determine the total coverage limit of a captive's policies, ensuring that the policies provide adequate coverage for all insured risks. B. Actuaries are primarily responsible for assessing the financial health of a captive, ensuring it maintains sufficient reserves and surplus. C. Actuaries calculate the appropriate premium rates for each risk covered by the captive, ensuring that premiums are sufficient to cover expected claims and expenses. D. Actuarial analysis is not necessary for captives that focus on low-risk policies, as these can be priced based on historical loss data alone. Answer: C. Actuaries calculate the appropriate premium rates for each risk covered by the captive, ensuring that premiums are sufficient to cover expected claims and expenses. Explanation: Actuarial analysis is a key component in the premium setting process for captive insurance companies. Actuaries assess the risks associated with each policy and calculate the appropriate premium to ensure that it is sufficient to cover expected claims, administrative costs, and other expenses. This process is essential to maintain the financial stability of the captive. Option A is incorrect because actuarial analysis does not primarily determine coverage limits, although it may influence the limits based on the risks involved. Option B is only partially correct, as actuaries do assess financial health but focus more on premium calculations than on overall solvency. Option D is incorrect because even low-risk policies require actuarial input to ensure proper pricing and financial viability. Question 9. Which of the following is the primary purpose of using reinsurance within a captive insurance structure? A. To diversify the captive's portfolio by adding new lines of insurance coverage from other markets. B. To increase the capital base of the captive without requiring additional investment from the owners. C. To transfer some of the risks retained by the captive to a third-party insurer, thus protecting the captive from large catastrophic losses. D. To lower the cost of premiums for the captive's policyholders by negotiating lower rates with commercial insurers. Answer: C. To transfer some of the risks retained by the captive to a third-party insurer, thus protecting the captive from large catastrophic losses. Explanation: Reinsurance is used by captive insurance companies to transfer a portion of the risk they have assumed to third-party insurers. This is particularly useful for protecting the captive against large catastrophic losses that may exceed its capacity to pay claims. By transferring risk, the captive can better manage its exposure and ensure long-term financial stability. Option is incorrect because reinsurance is not typically used for diversifying the captive's portfolio. It is more about managing risk. Option B is inaccurate as reinsurance does not directly increase a captive's capital but helps manage risk exposure. Option D is misleading because reinsurance does not directly lower premiums for policyholders but rather helps the captive manage its own risk exposure. Question 10. In Alabama, who is responsible for the financial examination of a captive insurance company to ensure compliance with state regulations? A. The captive insurance company's external auditors. B. The Alabama Department of Insurance, DOI. C. The captive insurance company's management team. D. A third-party independent insurance rating agency. Answer: B. The Alabama Department of Insurance, DOI. Explanation: in Alabama, as in many states, the Alabama Department of Insurance, DOI, is responsible for the financial examination of captive insurance companies to ensure compliance with state laws and regulations. This includes reviewing the captive's financial statements, ensuring adequate reserves and capital, and verifying that the captive operates within the legal and regulatory framework established by the state. The DOI conducts periodic examinations to assess the solvency and operations of captive insurers. Option is incorrect because while external auditors play an important role in auditing financial records, they do not have the regulatory authority to conduct state-required examinations. Option C is incorrect as the management team may be involved in internal audits or reviews but does not have the authority to conduct a state examination. Option D is incorrect because independent insurance rating agencies assess the creditworthiness of insurance companies but do not have the authority to conduct state regulatory examinations. Question 11. Which of the following is a primary benefit of establishing a captive insurance company? A. Increased access to commercial reinsurance markets. B. Greater control over risk management and insurance costs. C. Low regulatory scrutiny from the state insurance department. D. Reduced tax liabilities for the parent company in all circumstances. Answer: B. Greater control over risk management and insurance costs. Explanation: the primary benefit of establishing a captive insurance company is that it allows the parent company to have greater control over its risk management and insurance costs. Captives enable businesses to customize their insurance policies to better suit their specific needs, often resulting in lower premiums and more efficient risk management. Option A is incorrect because captives typically don't increase access to commercial reinsurance markets but rather provide an alternative risk financing method. Option C is incorrect because captives are subject to substantial regulatory scrutiny, though it may be less burdensome than traditional insurance companies. Option D is incorrect because captives may offer tax advantages, but they are not a guaranteed means of reducing tax liabilities in all situations. Question 12. Under Alabama law, what is the minimum capital requirement for a pure captive insurance company? A. $1 million. B. $2 million. C. $500,000. D. $3 million. Answer: B. $2 million. Explanation: under Alabama law, a pure captive insurance company must maintain a minimum capital of $2 million. This capital ensures that the company has sufficient financial resources to meet its obligations. This amount is mandated to support the company's operations, safeguard policyholders, and ensure the company's solvency. The minimum capital requirement for different types of captives can vary, but for a pure captive, $2 million is the standard under Alabama's regulatory framework. Option A, C, and D are incorrect as they do not reflect the capital amount specified by the state. Question 13. Mr. Taylor, the CEO of a construction company, wants to set up a captive insurance company to manage the risks associated with his business. He needs to make a decision regarding whether to set up a pure captive or a group captive. Which of the following would make the most sense for Mr. Taylor? A. Setting up a pure captive as his business has significant unique risks that are not shared with others. B. Setting up a group captive as it is likely more cost-effective due to shared risks and expenses. C. Setting up a pure captive to avoid state regulatory oversight. D. Setting up a group captive to increase diversification of his insurance portfolio. Answer: A. Setting up a pure captive as his business has significant unique risks that are not shared with others. Explanation: a pure captive insurance company is typically formed by a single entity or group of related entities to insure only its own risks. Given that Mr. Taylor's construction company has significant unique risks, he G. Construction-related liabilities, equipment risks. A pure captive would be the most suitable option. A group captive, on the other hand, is usually formed by multiple companies to share risks, making it a more cost-effective option for businesses that have similar risks. Option C is incorrect because pure captives still face state regulatory oversight. Option D is also incorrect because a group captive is often more cost-effective, but not for purposes of increasing diversification. Question 14. Which of the following is the primary responsibility of a captive insurance company's board of directors under Alabama law? A. Ensuring that the captive is profitable and generates dividends for the parent company. B. Overseeing the operations of the captive to ensure compliance with regulatory requirements. C. Making all underwriting and claims decisions without involving management. D. Determining the specific reinsurance arrangements of the captive without input from external advisors. Answer: B. Overseeing the operations of the captive to ensure compliance with regulatory requirements. Explanation: the board of directors of a captive insurance company is responsible for overseeing the company's operations, ensuring compliance with regulatory requirements, and maintaining sound governance. This includes making sure the company adheres to applicable Alabama state laws, federal regulations, and internal policies. While profitability is important, it is not the board's sole responsibility to ensure profits or dividends for the parent company. Option is incorrect because the board's focus is on compliance and governance, not direct profit generation. Option C is incorrect because underwriting and claims decisions are generally handled by the management team. Option D is incorrect because reinsurance arrangements typically involve input from advisors and specialists. Question 15. Which of the following best describes a protected cell captive insurance company? A. A captive that only insures a single risk for the parent company. B. A company that insures multiple unrelated entities, each in its own separate cell. C. A type of reinsurance company that provides coverage for multiple types of risks. D. A captive with multiple shareholders who each own a part of the company. Answer: B. A company that insures multiple unrelated entities, each in its own separate cell. Explanation: a protected cell captive is a type of captive insurance company where multiple unrelated entities, often called participants, can insure their risks in separate, legally distinct cells. Each cell within the protected cell structure is segregated from others, meaning that the assets and liabilities of one cell are protected from those of the others. This structure allows for shared services and resources while maintaining the separation of financial risks. Option is incorrect because a pure captive insures a single entity's risks. Option C is incorrect because reinsurance companies provide reinsurance, not primary insurance. Option D is incorrect because protected cell captives do not have multiple shareholders in the same way traditional insurance companies do. Question 16. How does the Risk Retention Act of 1986 impact captive insurance companies? A. It requires captives to submit a detailed risk retention plan to the federal government. B. It allows captives to operate in multiple states without having to comply with each state's regulations. C. It allows captives to underwrite the risks of unrelated businesses and industries. D. It restricts captives to only insuring the risks of the parent company. Answer: B. It allows captives to operate in multiple states without having to comply with each state's regulations. Explanation: the Risk Retention Act of 1986 allows for the formation of risk retention RRGS, which are a specific type of captive insurance company. RRGS can operate across state lines without having to comply with each state's individual insurance regulations, provided they meet federal requirements. This provides flexibility for captives in interstate commerce. Option is incorrect because the Act does not require captives to submit a detailed risk retention plan to the federal government. Option C is incorrect because RRGS solely insure the risks of their members, not unrelated businesses. Option D is incorrect because RRGS, unlike other captives, are allowed to insure the risks of multiple businesses. Question 17. Which of the following is a major drawback of utilizing a captive insurance company? A. The captive is subject to heavy taxation, making it less cost-effective. B. The captive must maintain minimum levels of surplus and reserves, which can be costly. C. The captive is exempt from all state regulations. D. The captive does not require professional management or advisors. Answer: B. The captive must maintain minimum levels of surplus and reserves, which can be costly. Explanation: a major drawback of utilizing a captive insurance company is the need to maintain substantial levels of surplus and reserves to ensure solvency and meet regulatory requirements. This can be a significant financial burden, especially for smaller companies. Option A is incorrect because captives often provide tax advantages and are not heavily taxed. Option C is incorrect because captives are subject to state and federal regulations, particularly regarding solvency, operations, and reporting. Option D is incorrect because captives generally require professional management and advisors such as actuaries and legal experts to ensure compliance and proper operations. Question 18. Which of the following is typically covered under a captive insurance company's general liability policy? A. Product recall costs. B. Costs related to natural disasters. C. Liability claims arising from third-party bodily injury or property damage. D. Reinsurance premiums for excess coverage. Answer: C. Liability claims arising from third-party bodily injury or property damage. Explanation: a general liability policy written by a captive insurance company typically covers third-party liability claims such as bodily injury or property damage arising from the insured's operations. These policies are designed to protect the parent company from claims made by external parties. Option is incorrect because product recall costs are typically covered by product liability insurance, not general liability. Option B is incorrect because natural disaster coverage would typically fall under property or catastrophe policy. Option D is incorrect because reinsurance premiums are not covered under a general liability policy, they would be a separate line of coverage. Question 19. Which of the following best defines self-insurance as compared to captive insurance? A. Self-insurance involves the company assuming full responsibility for its insurance claims, while captive insurance is used to transfer risk to an external entity. B. Self-insurance is a form of insurance that protects against catastrophic losses, while captive insurance is for general liabilities. C. Self-insurance involves creating an internal fund to cover losses, while captive insurance creates a separate insurance entity. D. Self-insurance is illegal in most states, while captive insurance is widely recognized. Answer: C. Self-insurance involves creating an internal fund to cover losses, while captive insurance creates a separate insurance entity. Explanation: self-insurance refers to the practice of setting aside internal funds to cover the costs of potential insurance claims rather than purchasing an external insurance policy. It is essentially the company assuming the financial risk and managing it within its own operations. Captive insurance, on the other hand, involves creating a separate legal entity, the captive, that assumes the insurance risk and provides coverage to the parent company or its affiliates. Option A is incorrect because both self-insurance and captive insurance involve assuming some level of risk, but captive insurance still creates a separate entity. Option B is incorrect because self-insurance can cover any type of loss, not just catastrophic losses, while captives can cover both general and specialized risks. Option D is incorrect because self-insurance is legal in most states and captive insurance is also widely recognized. Question 20. Which of the following factors is most critical in determining the feasibility of forming a captive insurance company in Alabama? A. The company's credit score and history with insurance providers. B. The availability of external investors willing to contribute capital. C. The parent company's risk profile and the ability to absorb potential losses. D. The company's desire to reduce operational costs. Answer: C. The parent company's risk profile and the ability to absorb potential losses. Explanation: when determining the feasibility of forming a captive insurance company, the most critical factor is the parent company's risk profile and its ability to absorb potential losses. Captive insurance is often formed to manage risks that are either too costly or difficult to insure through traditional insurance markets. The parent company must have a stable financial situation to ensure that it can cover the claims or losses that might arise. While credit score, external investors, and cost reduction may influence the decision, the company's risk management needs and financial capacity are the primary drivers. Option A is incorrect because while credit history is important for securing external capital, it is not the primary factor. Option B is incorrect because external investors are not typically involved in captives, which are owned by the parent company. Option D is incorrect because reducing operational costs is often a benefit of forming a captive, not the main reason for its feasibility. Question 21. Which of the following is true regarding the regulatory oversight of captive insurance companies in Alabama? A. Captive insurance companies are completely exempt from state insurance regulations. B. Captives are regulated by the Alabama Department of Insurance and must comply with specific state laws. C. Captive insurance companies are only regulated at the federal level. D. Captive insurance companies in Alabama are not required to maintain financial reserves. Answer: B. Captives are regulated by the Alabama Department of Insurance and must comply with specific state laws. Explanation: Captive insurance companies in Alabama are subject to oversight by the Alabama Department of Insurance. They must comply with various state regulations, including those related to capitalization, reporting, and maintaining reserves to ensure financial solvency. While captives are subject to some different regulatory requirements compared to traditional insurers, they are still required to meet state regulatory standards. Option is incorrect because captives are not exempt from state regulations and they must comply with the state's legal framework. Option C is incorrect because captives are regulated at the state level, not exclusively at the federal level. Option D is incorrect because financial reserves are required to ensure that captives can cover potential claims. Question 22. What is the minimum amount of surplus required for a captive insurance company to be licensed in Alabama? A. $100,000. B. $500,000. C. $1 million. D. $2 million. Answer: D. $2 million. Explanation: under Alabama law, a captive insurance company must have a minimum surplus of $2 million to be licensed. This ensures the company has sufficient financial resources to meet its obligations and maintain solvency. The minimum surplus requirement varies by the type of captive, e.g., pure captive, group captive, but for a pure captive in Alabama, the requirement is $2 million. Option A, B, and C are incorrect because they do not meet the state's legal requirement for the minimum surplus for a pure captive. Question 23. Which of the following is typically covered by a captive insurance company's property insurance policy? A. Third-party bodily injury claims. B. Losses related to property damage caused by natural disasters. C. Product liability claims for defects in manufactured products. D. Employee health and life insurance claims. Answer: B. Losses related to property damage caused by natural disasters. Explanation: a property insurance policy provided by a captive insurance company generally covers losses related to property damage, including damage from natural disasters such as floods, earthquakes, or fires. Captive insurance companies can tailor their policies to cover the specific risks faced by the parent company. Option is incorrect because bodily injury claims are typically covered under general liability policy. Option C is incorrect because product liability claims would be covered under product liability insurance, not property insurance. Option D is incorrect because employee health and life insurance would be a separate policy, not typically covered by a property insurance policy. Question 24. Which of the following is one of the primary goals of a captive insurance company? A. To generate profits for external shareholders. B. To manage and finance the risks of the parent company or its affiliates. C. To compete with traditional insurance companies for market share. D. To increase the premium revenue collected from policyholders. Answer: B. To manage and finance the risks of the parent company or its affiliates. Explanation: the primary goal of a captive insurance company is to manage and finance the risks of the parent company or its affiliates. Captives provide a more tailored, cost-effective solution for risk management by allowing companies to insure their own risks, rather than relying on traditional insurance markets. Option A is incorrect because captives are not designed to generate profits for external shareholders but to serve the needs of the parent company. Option C is incorrect because captives do not compete with traditional insurance companies for market share, and they are a specialized form of self-insurance. Option D is incorrect because while captives generate revenue through premiums, their primary goal is risk management rather than profit generation. Question 25. What type of risks are most commonly insured by a captive insurance company? A. High-frequency, low-severity risks such as general business liabilities. B. Low-frequency, high-severity risks such as natural disasters or large claims. C. Only auto-related risks. D. Risks that are universally covered by commercial insurers. Answer: B. Low-frequency, high-severity risks such as natural disasters or large claims. Explanation: captive insurance companies are commonly used to cover low-frequency, high-severity risks, such as natural disasters, large liability claims, or other rare but catastrophic events. Captives can be structured to provide coverage for these types of risks that may be difficult or expensive to insure through traditional insurance markets. Option is incorrect because high-frequency, low-severity risks are generally more suitable for traditional insurers. Option C is incorrect because captives can cover a wide range of risks, not just auto-related ones. Option D is incorrect because captives often cover risks that are not typically covered or are costly to insure through commercial insurers. Question 26. Under Alabama law, how frequently must a captive insurance company submit its annual report to the Alabama Department of Insurance? A. Monthly, B. Quarterly, C. Annually, D. Every 2 years. Answer: C. Annually. Explanation: captive insurance companies in Alabama must submit an annual report to the Alabama Department of Insurance. This report typically includes financial statements, details on the company's operations, and compliance with state regulations. Annual reporting helps ensure that the captive remains solvent and compliant with regulatory requirements. Option A, B, and D are incorrect because captives are required to submit reports on an annual basis, not monthly, quarterly, or every 2 years. Question 27. What is the primary benefit of a parent company establishing a captive insurance company in Alabama? A. To avoid paying taxes on insurance premiums. B. To transfer all insurance risk to a third-party insurer. C. To have greater control over the company's insurance policies and costs. D. To reduce the regulatory oversight of the insurance industry. Answer: C. To have greater control over the company's insurance policies and costs. Explanation: the primary benefit of establishing a captive insurance company is that the parent company gains greater control over its insurance policies and the associated costs. Captives allow a company to tailor its insurance coverage to meet its specific risk profile, provide better claims management, and potentially lower its overall insurance costs. Option is incorrect because captives are still subject to regulatory oversight, including taxes. Option B is incorrect because a captive is created to retain risk within the organization, not to transfer it to a third party. Option D is incorrect because captives are still regulated by state authorities such as the Alabama Department of Insurance. Question 20. Which of the following is a common reason that companies choose to establish a group captive insurance company? A. To reduce the number of insurance claims made by the parent company. B. To share risks and insurance costs among multiple unrelated companies. C. To increase the number of claims handled by the company. D. To insure risks that are not legally insurable through traditional markets. Answer: B. To share risks and insurance costs among multiple unrelated companies. Explanation: a group captive insurance company is typically established by multiple unrelated companies that wish to pool their resources to share risks and the associated insurance costs by combining their financial strength. These companies can benefit from economies of scale, more favorable premiums, and better coverage options. Option is incorrect because reducing claims is not the primary goal of a group captive, and risk sharing is the main focus. Option C is incorrect because captives are designed to manage risk, not increase the number of claims. Option D is incorrect because while captives can insure difficult to cover risks, it does not necessarily involve insuring risks that are not legally insurable. Question 29. What is the typical capitalization requirement for a pure captive insurance company in Alabama? A. $100,000. B. $500,000. C. $1 million. D. $2 million. Answer: D. $2 million. Explanation: under Alabama law, a pure captive insurance company must have a minimum surplus capitalization of $2 million in order to be licensed. This requirement ensures that the captive has enough financial resources to absorb potential losses and remain solvent. Option A, B, and C are incorrect because they are below the required minimum for a pure captive. Question 30. Which of the following is a key factor in the management of a captive insurance company in Alabama? A. The parent company must rely on an external board of directors. B. The captive must maintain a risk management program that identifies and assesses risks. C. Captives are prohibited from offering coverage for employee benefits. D. Captives must report to both state and federal regulatory bodies annually. Answer: B. The captive must maintain a risk management program that identifies and assesses risks. Explanation: a key component of managing a captive insurance company is the implementation of a risk management program that identifies, assesses, and mitigates risks. This is critical to ensuring the financial health of the captive and its ability to cover claims. Option A is incorrect because while captives may have external directors, the parent company retains control over the management and operations. Option C is incorrect because captives can offer coverage for employee benefits if that is within the scope of their policies. Option D is incorrect because while captives are required to report to the state regulatory bodies, there is no federal regulatory requirement for annual reporting.